Canadian economy. We're joined by Philip Petursson. He's Chief Investment Strategist at IG Wealth Management. Nice to see you. Interesting week because you've got, on the one hand, a growing number of economists who say there's enough good stuff happening with the economy to justify more rate hikes. But now we've got these signs of cracks under the surface when it comes to Canadian consumers. What's your take?
Well, here we have to be very careful about the data that we're getting from the past versus the data that suggests where we're headed in the future. And so on the commentary of the rising debt levels, absolutely, I think that is a future problem, as well as the debt service ratio, which stands at about 14% of household income. So 14 cents of every dollar is going to service that debt. That's about double what it is in the United States. That's a problem looking ahead. The GDP numbers in the first quarter, while as encouraging as they are, that happened more than 3 months ago. So is that as relevant to the Bank of Canada's decision this week? I don't think so. I think they really need to focus on the forward outlook.
Does that mean you think they will just stay on the sidelines again this week?
I think for now they will. When I looked earlier yesterday, there was about a 45% probability of a rate hike priced into the futures market. So a little bit less than 50%. I'm on that little bit less than 50% side. I don't think they need to raise rates. I think let the economy continue to advance, which it is at a much slower pace. If you look at some of the other indicators, that would suggest a further rate hike is not necessary at this time.
Yeah, and if I guess if we look out over the next 6 months, if you had to guess between a real cool down justifying a slowdown on rate action versus the possibility that this resiliency, even if the stuff we've looked at so far is backward looking, if the new stuff shows some signs of that, could it be possible that they jump on the rate hike train again?
I think they could, but that needs to be supported by the data, and it's not there yet. When we look at rail freight, trucking surveys, it's all indicating that things are slowing down, not picking up. Again, we got to be careful about the past data versus the future data.
We're going to talk a little bit more about some of your sector strategy next block, but just what would be your overall message to investors who are trying to make sense of these economic headlines? Yeah,
so pay attention to the fundamental data in front of us, which is suggesting a weaker earnings environment and a weaker economic environment, and position yourself accordingly. That doesn't mean you have to shift wholesale out of equities, but measure your risks that you want to take and align your asset allocation appropriatly to that, which would mean underweight equities at this point.
And then I guess if people are looking at the headlines in the United States, like we've also got we're getting pretty close to an interest rate decision there as well, and the Fed has a big decision to make on their side of the fence.
Exactly, and I think they're going to do the same thing. I think they're going to pause. If you look at the recent trend in inflation in the United States and in Canada, it is heading in the right direction. The 6-month annualized rate of inflation is hovering around 3% in Canada, and it's coming down to that level in the United States. Well, that's not 2% in terms of their target, but we're getting closer to that. And in a year's time, I think we will achieve that 2% target, both in Canada and the U.S.
Okay.